Listen to my story about a man named Jed, a poor mountaineer, barely kept his family fed. And then one day he was shooting at some food, and up through the ground come a bubbling crude oil, that is, black gold, Texas tea.
Welcome once again to The Income Generation, the show where we focus on financial topics and information relevant to today's generation of retirees and near retirees. Information to help you sort through all the hype and confusion out there and to help you make educated decisions about your financial future. I'm your host, David Scranton. Now, if you're part of the income generation, which basically means you're over age 50, then you probably got just a little bit nostalgic watching that clip at the top of the show. But we didn't open today's show with Jed Clampett just for the sake of nostalgia. We did it as a fun way to highlight the topic that's going to dominate a lot of our discussion for the next hour. Hillbillies. No, not hillbillies. I'm talking about oil, black gold, Texas tea. You certainly don't need me to tell you that oil is a very big topic of discussion in the news these days. And it's always been to a certain extent. But since the first of the year, probably only the presidential race has grabbed more headlines and gotten more attention than oil. Why? Because the impact of plunging oil prices on the financial markets is more dramatic than anything we've seen in years. Naturally, the oil industry has a long history of booms and busts. But by some estimates, it's now in the deepest downturn since the 1990s, if not earlier. The reason is simple. The price of a barrel of oil has fallen by more than 60% since June of 2014. Meanwhile, the stock market had one of its worst beginnings of the year in the month of January in history, with record levels of volatility and the S&P 500 plunging by more than 6%. Obviously, there are a lot of different things influencing the markets right now, but most analysts have pinpointed the oil situation as a major cause of investor nervousness. So, how long will all this last? Will oil be the cause of the next major market crash? Is this current situation just another temporary downturn, or is it something more permanent for the oil industry? Something that might just possibly have major long-term repercussions for both investors as well as the global economy. Those are all big, important questions, and I can't think of anybody better qualified to talk about them than our guest today, Gary Sernovitz.
So we are clearly dealing with, in the oil business, a source of supply at a cost and at a volume and at a responsiveness that no one ever thought was imaginable.
Rusty Braziel.
Prices will go back up either when demand responds and demand increases or when supply drops. So a lot of what folks are waiting for these days is when and if supplies are going to drop, and presumably that would increase prices back to maybe not where they were, but certainly above $30 or $40.
Oil has been called the lifeblood of the global economy, and that's a fairly accurate description. It's also been said that oil and finance have proven themselves to be the only two industries able to topple the world into an economic recession. That's also fairly accurate. If you've watched this show in the past, you may have heard me talk about my concerns about deflation and how a deflationary spiral could trigger a new recession here in the United States. Well, I believe you can make the case that Wall Street's worries over oil prices right now are at least partly a sign that the financial markets are worried about deflation also, and ultimately about a possible recession. In fact, not long before we recorded this show, a new report showed that U.S. companies are growing more and more concerned about the possibility of recession in the coming year than any time since 2009. According to this report, the number of CEOs who've mentioned the word recession is up 33% from a year ago. Slow GDP growth in the last quarter of 2015 is partly to blame, but the bigger concern cited in the report was, you guessed it, oil. Companies and shareholders are increasingly worried that the steep drops in energy prices and layoffs in the industry are going to bleed into the larger economy. Since the current downturn began, an estimated 250,000 oil workers have lost their jobs. Keeping the big picture in mind, the irony in all of this is that cheaper fuel really should be a good thing for the global economy in the long run. As one recent article put it, cheaper oil should act like a shot of adrenaline to global growth. In fact, by some estimates, the current price cut, with oil down around $30 a barrel or so, shifts some $1.3 trillion from producers to consumers. And if this continues, the Bank of America Merrill Lynch estimates it will set the stage for one of the largest transfers of wealth in human history, shifting some $3 trillion a year from oil producers to consumers. But again, that's just one potential long-term outcome. Only time will tell if it plays out that way or if oil will eventually return to $90 or $100 a barrel. That's the level at which it had been pretty much the norm over the last decade. And we'll talk more about that later with Gary Sernovitz. Either way, the current situation is a questionable one with a lot of uncertainty and a lot of potential risks for investors, both large and small. So if you're retired or near retirement, if you're part of the income generation, you need to understand those risks. And that starts with understanding just why the markets seem more focused on the downside of cheap oil than on the potential economic benefits. Why they appear more worried about deflation despite the fact that cheap oil is giving consumers more spending money. So that's my focus on today's market breakdown. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. If you were to do any research on the following question, you get a lot of conflicting answers. And that question is, what is the relationship between oil prices and the stock market? Well, like anything related to the financial markets and the economy, it's a complicated issue. There is no single simple answer. In fact, you could make the case that what's going on right now makes no sense at all. Why? Because of the simple theory that if oil prices fall, the market should celebrate because it means consumers have more discretionary spending money. And that should be good for the economy. As I said in my opening, that may be a long-term outcome, but it isn't what's happening right now. Right now, there is not an inverse relationship between falling oil prices and a rising stock market, but a parallel relationship instead. As oil prices have plunged, so has the market. But that's not completely unusual either. Historically, the markets do sometimes react negatively to falling oil prices. And there are some tangible reasons for this, and emotional reasons as well. And I'll explain both in today's market breakdown. The tangible reasons are pretty simple to understand. Basically, it's a domino effect. The oil industry looms very large in the financial markets, and as oil companies' profits have plummeted, oil company shares have also plummeted. And that's played a big part in dragging down the stock market as a whole. There is also a lot of leveraged debt within the industry, which makes matters even worse. When oil prices were high, many banks, including some of the biggest on Wall Street, loaned energy companies money for drilling. And a lot of them have since had to set money aside to cover potential losses. It is estimated the oil and gas industry has about $500 billion in outstanding debt. But as I always stress, market performance is based more on emotion than on hard numbers. It's driven mainly by fear and greed. And we're seeing much more of the former now than the latter. And here's why I think that is. One reason that oil is typically seen as an indicator of the economy is simple. Most goods and services are delivered to their end retailer by cargo planes, by ships or trucks, all of which run on some derivative of oil. Therefore, when global demand for oil starts to decrease, it's one indication that global demand for goods and services is also decreasing. Of course, the real indicator of that is whether or not our GDP, our gross domestic product, has increased or decreased. But the problem with that is that those numbers typically aren't available for weeks after a quarter has ended. So meanwhile, the financial markets may view what's happening with oil prices as an early glimpse of a poor GDP report. I believe another issue has to do with speculators and the way oil is traded. You see, in the stock market overall, most people don't short stocks. At any given time in the stock market, you might have 90% of investors who are buying long, and maybe only 10% who are shorting the market. But oil is traded in the futures market, and by definition, for everyone taking a long position, there's also someone taking a short position. This effectively creates a 50-50 balance between the longs and the shorts. And because there are more pure speculators in the oil market taking short positions, it means that downside swings within the market are much more heavily weighted. When things start to slide in the oil market, speculators may start taking equity in their futures accounts to short more and more and more, similar to doubling down in a casino. The bottom line is that when things start to slide in the futures market, they can slide a lot further and a lot faster than in the stock market overall, as we've seen recently. So why are there so many speculators shorting oil right now? Well, part of it may have to do with the unusually mild winter we've seen so far in much of the country. Typically, oil companies, it means retail home heating companies, go long on futures early in the year because they want to lock in a price. But if it's been a warm winter, they may be in a position where they don't want or don't need to take delivery of all that oil that they've pre-ordered. In that case, they may be opting to reverse these long futures positions by buying short. In essence, this negates the transaction and the oil company locks in the loss. Now, they would have taken the same loss even without negating the transaction, but at least this saves them from having to take delivery of a lot of oil that they don't have room to store and their customers don't really need. And that brings up another point. By most accounts, the main reason oil prices are so low is simply that supply greatly outweighs demand right now. In the United States, advanced drilling technologies, namely fracking, have helped cause a huge glut. In fact, the United States has added more oil to the global market than the total production of any country in OPEC besides Saudi Arabia. The International Energy Agency predicts that global oil supply could outstrip demand by 1.5 million barrels per day. So, combining all these factors, a huge oil surplus, speculators shorting the price, and the potential implications of falling prices for the GDP, you can start to understand why the market seems so fearful. You can understand why they appear less optimistic about cheap oil helping to trigger inflation, instead more worried about it being a sign of deflation. Adding to those worries are some of the historically unprecedented factors I've talked about on previous shows, mainly the lingering effects of 6 years of quantitative easing. Remember, quantitative easing was supposed to help spur the economic recovery by giving people incentives to spend and borrow money. How? By giving them low interest rates and a thriving stock market that made them feel wealthy. But it didn't work that way. Regardless of those incentives, a lot of Americans have opted to focus on saving and paying down debts over the past 6 or 7 years. So, if Americans weren't motivated to spend by low interest rates in a climbing market, Wall Street may now think low fuel prices aren't going to do the trick either, at least not anytime soon. And if that's the case, then deflation is a very legitimate concern. Now, you certainly can't blame consumers for any of this. You've experienced 2 devastating stock market crashes in the last 16 years. You lived through the collapse of the housing market and the worst financial crisis in the country since the Great Depression. It's understandable and sensible that you'd be cautious. It's even more understandable if you're aware of another important factor connected to what's going on in the markets today, and this is stock market history. As I've talked about before, history indicates that the stock market is long overdue for another significant drop. This would be the 3rd drop of this long-term secular bear market cycle that started back in the year 2000. Add that to the fact that all the market instability is being blamed on oil right now, and the situation seems ever more unstable. Here's another simple fact you should know. A 2009 report demonstrated that nearly every stock market crash and recession of the last 50 years has occurred shortly after a large and abrupt change in the price of oil. In many cases, the cause and effect was just as I explained. The markets interpreted the price change as a sign that demand for goods and services was dropping, and that recession was on the way. What's more, there has only been one other time in history when the price of oil has crashed by more than $40 in less than a 6-month period. That was during the second half of 2008, at the peak of the financial crisis. So getting back to my original question, what is the relationship between oil prices and the stock market? Well, again, it's a complicated issue. But clearly there is a relationship, and only time will tell just how this current one plays out.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Welcome back. I'm here today with Rusty Braziel, who is the CEO of RBN Energy and also the author of the new book entitled The Domino Effect. Rusty, welcome to the show.
Thank you, David. Good to be with you.
Well, good to have you. First of all, your book, The Domino Effect, covers an in-depth analysis of both natural gas and crude oil and how oil prices become affected by market factors. Let's start there so our audience understands the factors at play in the industry.
Right. Of course, it's all about supply demand, right? So when supply is too high, if it's more supply than the market can absorb, prices go down. Prices will go back up either when demand responds and demand increases or when supply drops. So a lot of what folks are waiting for these days is when and if supplies are going to drop, and presumably that would increase prices back to maybe not where they were, but certainly above $30 or $40.
Now, some of this, of course, is on the demand side. I know there's been a lot of publicity lately about the supply side being problematic, the fact that especially Saudi Arabia keeps pumping oil. But the demand side also is a recent report just about a week ago that said that OPEC is actually predicting a reduced demand for oil products. So how much of this do you think is demand side versus supply side?
Well, I would say it's 75 or 80% supply side and 20% demand side. So what's happened over the past few years is that the United States shale production has increased substantially, 5 million barrels a day or so. Because of all of that increase in supply, for at least some period of time, there was enough increased demand in the world to absorb it, most coming from China. When the Chinese economy started to slow down and U.S. production kept increasing, that's what finally pushed oil prices over the brink, if you will, and drove prices down below $30.
Now, it's interesting because the demand side argument has been China, as you just mentioned, but the other part of it is that a lot of people have speculated that the reason that oil prices are dropping in part is because it's a symptom of some type of deflation that seems to be right around the corner. Any thoughts on that?
I'll be honest with you, I'm no expert on inflation and deflation. I think I'm an expert on oil prices and oil markets, and what's going on in oil markets is in fact not surprising at all. as you said, the book is about both natural gas. It's also about natural gas liquids, propane and butane, that are also big parts of this market. So 6 or 7 years ago, the shale phenomena, what we call the shale revolution in the United States, came to natural gas. When it came to natural gas prices crashed, and they've stayed low ever since. For a few years, producers started to shift their drilling budgets to drill for what's called wet gas. Wet gas contains lots of natural gas liquids, propanes and butanes, and production increased for those commodities for a few years. And guess what happened? Exactly the same thing. Production increased and prices crashed. It was just inevitable that the exact same thing would happen to crude oil. That's what has happened. So in other words, this is not anything surprising or anything new. And that's what the book talks about, the fact that this is all happening for a series of reasons, and those series of reasons can not only be understood, they can be predicted.
Great. How much of this do you think has to do with how speculators deal with oil? I'm referring to the recent price drop. You know, it's interesting, the stock market, which is more the side I usually focus on the show, the stock market is, most people, 90% of investors or so are long in stocks. Very few people are actually short. But in the oil markets and the way it's traded in the futures market, as you well know, for every person long, there has to be someone short. And as a result, when your fulcrum is right in the middle, it seems like if something gets out of whack by just a little bit, it can have a more profound effect. To what degree do you think that plays in with the degree to which we've seen recent volatility in prices?
It's been a big factor. So what was happening back about 2 months ago up until maybe 3 weeks ago was that every bit of bad news came into the market, and most of the news that was coming into this market was bad. Very high inventories, Saudis pumping more, Iran coming back into the market. The shorts got into the market and pounded it down. So the market never should have really dropped based on fundamentals down below $30, down to 26 bucks. It never should have happened that way, but it was the shorts that basically caused the market to overreact. Then when we started getting a little bit of good news, when we started to see the noises being made from OPEC and Russia about the possibility of some sort of deal, when we started to hear a little bit of good news about demand, then the shorts got spooked. They closed out their positions, made a lot of money, by the way, and prices started to run back up as they closed those positions out. So a lot of the exaggeration that we've seen in the market, not only driving down below 30, but frankly, right now, driving back above 40, it's happened because of those financial players.
You know, with fracking and with shale, how much more capacity do we have as a country? How close are we, in your professional opinion, to becoming energy independent?
That is a very hard equation to calculate because energy independent, well, does it include gas, natural gas? Does it include natural gas liquids? Are we only talking about crude oil? Now we're exporting crude oil. The reality is that we're still importing a significant amount of the crude oil that we use. A lot of that crude oil comes from Canada. So are we going to say that we're going to stop importing crude oil from Canada? That's pretty unlikely, if that's your definition of energy independence. So the real answer to it is that if you include all of North America and if you include all hydrocarbons, we're not far away from energy independence right now. But if you're only talking about crude oil and you're only talking about crude oil that we produce in the United States, and that's your definition of energy independence, it's a long way away.
Okay. Do you think, as a final question, do you think we're closer on the oil side to that energy independence or closer on the natural gas side?
Oh, natural gas, we are already there. And the first cargo of liquefied natural gas left Cheniere's dock just a few weeks ago. There'll be a lot more liquefied natural gas being shipped out of the United States. We can produce more natural gas in the United States that we can use. As a matter of fact, we are doing that right now, and that's the reason prices for natural gas are as low as they are. So we're already there on natural gas. We're already there on natural gas liquids, propane and butane. Only crude oil is the commodity where we're still importing significant barrels.
Rusty, that's been great. I've learned a lot. I thank you very much for being on the show today.
Thank you.
And go out and purchase the domino effect. You know, to me, this concept of energy independence is so important. I'm surprised it's not even more of a political hot button in the elections we're looking at right around the corner. Stay with us. We'll be right back. Near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm here with Gary Sernovitz. He's Managing Director of Lime Rock, which is a private equity firm focusing on oil and gas. He's also the author of the new book entitled Green and Black. Gary, welcome to the show.
Thank you for having me, David.
It's a pleasure. You know, your book, I know, talks a lot about shale, fracking, and the future of energy in general. But before we get to that, I want to talk about oil prices. In your professional opinion, what the heck has been going on with oil prices over the last several months and why?
You know, I always tend to think of the oil price and the shale revolution as pretty inextricably twinned. If you think about, Saudi Arabia has given a lot of the credit for sort of, causing the collapse in oil prices 18 months ago at that Thanksgiving in 2014. But they were really responding to the huge, really unprecedented and almost unimaginable kind of increase in production from the U.S. due to the shale revolution. So we are clearly dealing with, in the oil business, a source of supply at a cost and at a volume and at a responsiveness that no one ever thought was imaginable. And so what's happening now is the market's dealing with a very natural process of absorbing this, oversupply, and the business is restructuring itself totally.
Okay.
So I
that's
think
the supply side. No, that's the supply side. But there was a report that came out recently by OPEC, which actually projected that they see the demand for oil actually decreasing. So I guess my question is, how much of this do you think is a supply side overabundance versus a decreasing demand?
I think it's almost all historically over the last year and a half about supply. I mean, last year you actually had demand grow almost 2%, which was a pretty stunning increase in demand. And oil usually grows about 1 to 1.2% a year. This year I think OPEC, like everyone else, thinks oil is going to return to its more normal sort of demand growth of about 1%. So so I think the deceleration of demand is more of a return to normalcy rather than anything unusual, and people should expect oil to grow kind of 1.5% over the next kind of foreseeable future. But the U.S. Over kind of 2011, 2012 up to 2014 was actually growing its own supply more than global demand was growing, which is obviously unsustainable if the rest of the world wasn't restricting production in some way.
Okay. Now, on the demand side, do you see that the drop in the price of oil as being some kind of symptom of deflationary pressures worldwide?
I think it's really, my view, and obviously you can have a lot of experts and they're going to have a lot of different views. I think my view is the price of oil is really related to the specific outcomes of the shale revolution and the U.S. finding a way to extract oil and gas in really increasing technologically driven low cost on every month the wells get better and better and cheaper. So I think while you have sort of a global phenomenon of commodities declining based on sort of the one-time effect of China kind of going away, really when you look at oil, there's a lot of very specific oil industry factors that are probably as much of a cause as sort of the more global kind of issues.
Okay. I'm going to ask you now to go back for a minute to your days at Goldman when you were an oil stock analyst. And the question is, as you know, stocks in general, there are probably 9 people who are long stocks for every 1 person that's short the stock market. But oil is different because oil is traded in the futures market as a commodity, by definition, for every person long, there's a person short. So it seems to me that when the supply and demand factors get out of whack, that means the price of oil can be a lot more volatile than even the price of stocks, for example. What are your comments on that?
Yeah, I mean, I think the comical thing about the oil futures is they're almost always wrong. I mean, if you look at the last 5 years where the oil futures were trading 5 years out, they have been wrong as much on to below as too high as too low every year. So while the market, is efficient in some theoretical way, and what the futures in 5 years is the price you can sell or buy in the case of the futures market, it's actually not historically a great predictor of what actual oil prices are going to be in the next 5 years. And that's clearly a result of a lot of people using oil futures as a way to trade, on global economy, on dollar strength, as a way to hedge stocks or bonds. So you're absolutely right in sort of that's. That does, the speculation does play a role in how prices are set.
Absolutely. Now, we are, in the United States, number 2 in oil production out of all the OPEC countries, second only to Saudi Arabia. How much of that factor, that increase that we've had domestically in terms of our production, comes from fracking?
All of it. I mean, if you look at where the U.S. declining almost 30 straight years until 2008, 2009, when we started to increase, we've now effectively doubled U.S. production. All of that coming from onshore fields in Texas, North Dakota, primarily, but also some other places like Colorado. So it's been really an incredible sort of turnaround for the U.S. production, and has really, shocked the, on the supply side, the global oil markets, that are having trouble absorbing it.
Excellent. Well, Gary, I really appreciate your feedback today. You've added lots of words of wisdom to our show and for our viewers. And I have to tell you, though, I thought I had a fairly long subtitle in my own book. But I'm going to cheat now because your subtitle is even longer than mine. So we're wrapping up today with Gary Sernovitz, author of the book Green and Black. And the subtitle, which is very accurate, although it is long, is The Complete Story of the Shale Revolution, the Fight Over Fracking, and the Future of Energy. Gary, thanks again.
Thank you for having me.
Good. And for our viewers, stay with us. As soon as we come back, we'll be one-on-one between myself and Morgan talking more about oil and how oil affects the stock market. And that relationship we're seeing right now that may make no sense to any of us, we'll try to clarify that right off the break. We'll be right back.
The closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares were just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Ah, yes, another iconic TV show where oil was the central theme. David, this really is a topic that lends itself to some big picture discussion, as you mentioned at the top of the show.
Well, a big part of it is because, oil is such a popular topic today, and it's a huge industry. It's one of the biggest industries in our country.
And you wanted to devote an entire show to oil and not just focus on the big picture.
In large part because the media, right, the media so recently has been putting such a big emphasis on oil and an emphasis on whether this drop in oil prices is a good thing for the economy or whether it's a bad thing for the economy. And I felt like to some degree that question had to be answered here today.
You know, it is confusing and it's really central to what's happening with all the financial markets, correct?
Absolutely. And I think the bottom line is that people are saying it's common sense that, gee, with oil prices being low right now, people are saving money at the pump. I'm sure you feel it. I'm sure you feel some places where you've saved some money at the pump and things are going better. But yet you're reading the headlines saying, well, it's a bad thing for the markets.
You know, let's talk about that a little bit more because it is so confusing. There's so much speculation about this in the media, and I think a lot of it's contradictory. What are we supposed to think?
Well, I think people need to take a common sense approach here and say, well, if it makes sense for oil, cheap oil that is, to be a stimulator for the economy, and it seems to be sending another message to Wall Street right now, they have to ask why. They've got to say, why is it, what is it that's causing this? Things that we're answering on today's show.
Now, you spoke briefly in the market breakdown about the lingering effects of quantitative easing and how that's having an effect here. It really doesn't seem to add up to a lot, does it?
No, and quantitative easing caused a problem from the beginning, and overstimulated the economy. And a big problem that I like to say is it's kind of like a pharmaceutical company. Imagine a pharmaceutical company comes out with a new drug, for example, and they don't test the drug in advance. Well, if you come out with a new drug and you don't test it, people are going to get hurt. Physically, people are going to die. It's a terrible experience. And that's what they did with these unprecedented levels of quantitative easing. The Federal Reserve came out with an untested strategy. And now I think we're about to pay the price for all of that.
Just throwing it out there without knowing the effect, that is scary.
Sure.
And in this instance, you think quantitative easing is at least partly to blame for the markets focusing more on the negative side of cheap oil rather than the positives?
Yes, I think it's because the economy got overinflated. And when the economy gets overinflated for a period of time, eventually we have to go into some kind of recessionary cycle. That's what happens. You go from boom to bust and back to boom again. So when oil prices, as a result, were coming down, people are saying, well, maybe that's what's happening. Maybe the economy got overstimulated.
So you think, oh my gosh, I'm saving so much money at the pump. This is great. I'm going to have so much more disposable income. And that's not really what's happening.
No, but I mean, the average American today has an extra 2% in their paycheck, net. Why? Because of what they're saving at the pump, what they're saving in costs of home heating fuel and so on. I mean, you must see that in your own life.
Well, I definitely feel like I'm saving money, and it's much more pleasant to go to the pump now than it used to be. But, I'm not redoing my flooring anytime soon. I don't feel like I've saved that much.
Well, that's my question. So are you going out, are you borrowing more money, or are you spending money on certain items that maybe you weren't doing 6 months ago?
I don't think so. I don't really feel any different.
So it's really a question of wait and see. And again, that's why I want to do the show today, because I'm really concerned about that wait and see attitude. I'm concerned that right now what's happening is all of our income generation members are taking a wait and see type philosophy with the markets. And as a result, that's why they're not spending. That's why the economy has really slowed down at this point, or at least showing signs of slowing down.
Well, you've talked about this on an earlier show, that the wealth effect in reverse. What exactly is that?
Well, the wealth effect, of course, is when all this quantitative easing drove up financial market values, drove up the values of real estate, drove up the values of the stock market, and made people feel more affluent. Well, now the wealth effect in reverse is the financial markets are coming back down, and people feel poor. And when they feel poor, they're less likely to go out and spend money. And if they don't spend money, we don't stimulate the economy, we go back into recession.
A little bit like what I was saying in my personal life. We should feel like we have all this extra money, but we really don't.
Yeah, there's just a sense of it. The average person today just has a sense that things aren't quite right. Things are a lot better than they were back in 2008, but they're certainly not like they were in 2005 or 6.
So has anything really changed? I know they've changed the interest rates a bit, but not a lot.
Well, short-term interest rates, as you know, went up in December.
Right.
And a lot of that, I believe, was just the Federal Reserve getting pressured from Wall Street. It seemed like Wall Street wanted them to raise rates, so they raised rates. And I've already talked about some negative effects earlier in the show that concerns that I have about them taking that action.
And they'd already done that once before, correct?
It's been a long time since they raised short-term rates. This is the first time in about 10 years they actually had done that.
Okay.
But it's the first time they've raised rates after this extended period of quantitative easing.
Aha. So then what are we going to see happening? What is the effect of all of this?
Well, the problem is this thing we always talk about called the flat yield curve, and my concerns about what the flat yield curve might be able to do, negatively speaking, for our economy.
And what does it do exactly? What is it?
Well, the flat yield curve is a fancy term that financial people like to use for the difference between short-term and long-term interest rates.
Okay.
And the premise is that banks need long-term interest rates to be higher than short-term interest rates to lend.
Okay.
And what's happened since December 16th, when the Fed first raised short-term rates, is not only did short-term rates go up as a result of that, but also long-term rates came down because of worldwide economic conditions. So the spread between short-term and long-term has been decreased by about a third since December 16th.
Wow, and we see yet another reason for Wall Street's pessimism.
That's right, because that's often a sign or something that could very well trigger us going into the next recession.
And you said the rate hike was badly timed for two reasons.
The other reason is because Janet Yellen said right on December 16th that she really wants to continue to create inflation or to begin to create inflation. She's been trying to do this through all the quantitative easing since 2008.
Okay.
And the reality is they've had a difficult time doing it. And when you raise rates, it doesn't help create inflation. If anything, it has the opposite effect. It actually helps create deflation.
And that's bad. Why?
And that's bad because when the dollar gets stronger, which is what happens when you raise interest rates, the dollar should get a little stronger.
Seems like that'd be a good thing.
You think, but it makes it harder for our companies here in the United States to export goods and services because now other foreign countries need to use more of their currency to buy our goods. And that's something else that can very well cause us to nosedive right into a recession.
And people will buy things from other markets instead of our own.
That's correct, and that's obviously not what we want here in the United States.
So based on all of this, I assume you haven't changed your mind about 2016 being where we might see the third major market drop?
No, I believe 2016 could very well be that year, and it's not like I'm setting in stone or anything like that at this point, but it very well could be the year that we have that drop that could be as big as or more than 50%. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. If you're a part of the income generation, my generation that is, then the following images are probably going to ring a bell. Whether you were driving yourself at the time or in the back seat of your parents' car, chances are you remember very well the gas lines of the 1970s. If you were an adult back then, you may also recall what caused all that hysteria and irritation. The oil crisis, or first oil shock. It was set off by an embargo created by the Arab members of OPEC. By the end of it, the price of a barrel of oil had tripled globally, and the United States prices were even higher. Most people would probably agree. We've come a long way since then, and mainly in a positive direction where oil is concerned. We've decreased our dependence on foreign oil. We've improved the energy efficiency of our cars and other machines dependent upon oil. Also, we've cultivated new sources of energy. I'm not guaranteeing we'll never see gas lines again, but we've definitely greatly improved our odds of not having to live through the same kind of oil crisis we went through twice in the 1970s. What's happening right now in the oil industry is a good indication of that. As a man who has to buy fuel for a car, a boat, and a couple of houses, I'm certainly happy about lower prices. And if you're working hard to buy groceries, put your kids through college, and save for retirement, I'm betting you're happy too. Because every little bit counts. But naturally, there are two sides to every coin. A thing that benefits one group or individual often comes at a cost to another. In this case, that's the oil industry. Now, no one likes to pick up the paper and read headlines about job cuts or companies going bankrupt, obviously. But those are the downside consequences of plunging oil prices. And as we explained, they've had some direct impacts on market performance. Nosediving profits for oil companies have meant nosediving stock values as well. And that's bad for the overall stock market. I hope that I've helped clarify on today's show why I believe Wall Street's extreme unease over oil is based not just on these direct impacts, but on a combination of factors. Factors that indicate the markets aren't just worried about oil or the industry's struggles about the future of oil, but about the direction of the economy overall. In a word, worried about deflation and potential recession. My point in highlighting these other factors is not so much to explain everything that's been happening, but instead to help formulate some educated answers to those questions everyone's been asking. And those questions which I brought up at the top of today's show, namely, how long will this last? Will it get worse? Is oil going to be the tipping point for the next major sustained stock market plunge? First, how long will it last? Well, it could last quite a while. As I mentioned earlier, production hasn't really slowed domestically or abroad despite the price drop. U.S. oil reserves are already at their highest level in at least 80 years, and that supply is only going to increase. So if the current price plunge is based mainly on an overabundance of supply, which in part it is, that doesn't look as if it will change anytime soon. Some experts have estimated it could be many years before oil returns to the $90 to $100 per barrel range, the average price over the last decade. And again, it could be even longer than that if what we're seeing is a historic shift for the entire industry. A shift that sees oil lose some of its power as a global economic force. Is it going to get worse? That certainly seems possible also. If oil prices don't move up and they remain a constant source of investor unease, then every bit of bad economic news that comes along is only going to add to that unease. And we've seen some bad news lately. Only a week or so before I taped this show, these were just a few of the morning headlines. Jobless claims rise more than expected. Dow futures drop 100 on weaker oil and economic data. The last one illustrates my point perfectly. And those are just domestic headlines. Let's not forget all the uncertainty still going on with China's markets as well as the Eurozone. If oil continues to keep Wall Street on edge, then yes, any number of things could crop up to make matters worse. Is oil going to be the next tipping point for next major sustained stock market plunge? No, not oil per se, but as I hope I've demonstrated with today's show, it's one of the major factors in what seems to me to be a perfect storm. It's oil combined with the lingering effects of quantitative easing, the flat yield curve, and the overall economic picture. It's oil combined with other deflationary triggers and with global market instability, as well as the lessons of stock market history. It's oil, yes, but it's really all these factors that lead me to say that right now, it feels a lot like 2007 all over again. And to believe that 2016 may very well be the year that this third major market collapse, possibly as high as 50% or more, takes hold. Now, will oil be blamed for the crash in hindsight? Or will it be correctly seen as just one contributing factor? Who knows? But the more important question is, do you really care? Does it really matter what history says after the fact? Absolutely not. All that really matters is that you understand the current situation, you know the potential consequences, and can take the steps to protect yourself beforehand. As you know, for the income generation, I believe that defensive income-based financial strategies, protected from the volatility of the stock market, are going to be the key to dependable retirement planning for the next several years. The oil situation is just one of the many reasons why. Thanks for watching.